right, so we're now live. Hello, everybody. Welcome to CoinFund Q&A with IntelliSys, Jason Granger and Charlie Shrem's new project. So before we start, let me just say it's been a pretty crazy year for blockchains. Fair to say it's been a hell of a year. In the beginning, we saw Ethereum produce pretty intense returns. Now we're watching Bitcoin trade above 800 bucks at levels that we haven't seen since like 2014, 2013. And in the middle, we had a DAO hack. We had cryptocurrencies get split in half in the form of Ethereum Classic. We've had DOS attacks. We've seen interesting projects come out and get mainstream users, like, for example, Steemit. And I think one takeaway from 2016 is that a lot of respectable companies in our space have either embraced or really embraced the idea that digital assets, cryptographic tokens, create new and interesting business models, opportunities for fundraising. And the volume of crowd sales that we've seen, especially in the second half of 2016, has been like pretty unprecedented and raised, according to Smith & Crown, basically over $270 million so far. So my prediction for 2017 is that we're going to continue to see this phenomenon, and also that companies will be experimenting with the idea of bridging the gap, right, between the echo chamber that our space has been and kind of more traditional investments, more traditional businesses, and marrying these models of tokens with sort of more traditional equity models and fundraising models. So with that, I think this project, IntelliSys, which is a private equity fund that means to fundraise with digital assets, kind of falls into that category. And I want to welcome Jason and Charlie here. And I'll give the floor to Jason now to introduce the project and go from there.
Sure. Well, thanks for the introduction, Jake. It's nice to be in this kind of forum. It's nice to be able to get a lot of good constructive feedback and really have a format that we can openly communicate what our plans are, but then talk about how that really is going to make a difference in the whole marketplace. One of the reasons why Charlie and I got together in the first place was because there's been a lot of, we all have seen all of the projects come online through crowd sales this year. Some are creating new technologies, some are creating new types of blockchains. And one of the things that I think has been missing from our perspective, because I come from the more the traditional sense of finance and investment, unlike most of you guys here. And one of the things that's missing is this level of governance and transparency as it relates to, okay, once we give you all the money, what are you going to do with it? What do we expect? What is the timeline? Getting updates and feedback and communication from whatever team is going through that. And one of the things that we noticed was that there's a significant gap. The DAO was one end of the extreme with a big raise that everyone just threw a whole bunch of their Ethereum profits into this big crowdfund. But there really wasn't any leadership there to say, okay, well, here's how we're going to be organized, here's how we're going to be structured, here's how we're going to actually make use of those funds in a responsible and effective manner. And then the hack came. So no one really had time to plan. I don't think they expected to raise $150 million in 60 days, but it was pretty significant. And I think it told everyone to kind of put all of blockchain, including Bitcoin, on the map. And that was when I started thinking, as I was going through, I was building a pipeline and going to go the traditional route of the private equity raise. And I'm like, oh wow, there's this new market that's opening up, and a lot of people are hungry for some kind of investment opportunity. But Charlie and I, as we were forming this, really said, okay, well, we need really good legal. Let's go get that. Instead of trying to skirt around, hey, we're not really a security, so we're going to kind of pretend we're not. And then someday down the road, regulatory agencies come knocking on our door and say, hey, well, how can we start this the right way? How can we really get the right legal guidance, the right financial guidance, really set this up in a traditional sense, and then use the blockchain for what it's already capable of doing with, with Ethereum that has a smart contract functionality. Because one of the things we wanted to do was tokenize, make a liquid opportunity of investment into private equity, which doesn't exist. And so that really got us excited.
So let's dig into that a little bit. Like, where do you see kind of the synergy between a traditional fund and a digital token, which, what we see in other projects is that these tokens give kind of democratic access, they give liquidity, they, in certain cases give higher returns, depending on what you're investing in. Where do you see the benefit, let's say, of a token in this scheme?
Well, let's look at the landscape of the traditional world of private equity. First of all, private equity is a very, there's a churn that goes on, right? You're trying to find a place to put it, you're trying to add value, create value, and then you're trying to get out. I mean, there's that window of investment that you're trying to fight against. And when you're an investor in a private equity fund, whether it be in the real estate side or operating companies, or on the VC side, focus more on startups, you're looking for significant returns in varying degrees of risk, but your investment is always captive. You can't ever, I mean, it's next to impossible, really, without having to take significant discounts to get your money back. And over a 3 to 5 year time period, investment strategy changes, your risk tolerance changes, and what we wanted to be able to provide is a way to make that a liquid investment opportunity in the same type of spaces. Because I think investors now are starting to want to have freedom from that. Freedom to be able to talk. I mean, in a private equity investment, you don't even get a vote. You don't get a say. You're trusting the manager to use your funds accordingly. Bigger investors may be able to speak a little bit louder, but at the same time, you don't really have much control. You're expecting the general partner to manage those funds for you. What we're trying to do is a little bit different. We're not to the extreme of the Dow, where everyone has a vote, but at the same time, we are going to make sure that we're open to listening as we look to make new investments. We want to be able to bring in the community to talk about it. There's not necessarily a voting mechanism in place when we start off, but we want to be able to allow investors to be able to have a say. Or we make it a good decision or a bad decision. We also have a whole team of advisors that's going to help us do that. So the tradability, the liquidity that we're trying to provide, we're talking with a lot of different exchanges right now. Who's going to list it, how it's going to be listed, how it's going to be managed. We're going through KYC and AML, which is a whole new world. The autonomy of Bitcoin is something great, but now regulatory agencies are starting to say, okay, well, we need to protect consumers. You can't just have every Joe Schmo in the United States investing in something and they don't even know the risks. So there's got to be something there backstopping. So that was the process that we went through to get through it.
Excellent, thank you. Let me turn to Charlie for a second. Hello, Charlie.
Hi.
So Charlie, I have a question, just kind of a general question for you as one of the earliest kind of pioneers of the Bitcoin space. Like what you see a lot these days from people like you who came into Bitcoin very, very early is a certain thesis about who will win, right? So like there's a group of people that say that Bitcoin is going to be the currency to get them all, and basically, there's a lot of skepticism toward this idea of altcoins. Can you talk a little bit about like your perspective on that, and how did you come to decide that like digital tokens are worthwhile?
Well, early on in the Bitcoin space, we had no 2011, 2012, we had no infrastructure built yet. We had nothing. We were just kind of building from the ground up and trying to grow this thing that we called Bitcoin. And we focused on the price a lot. We focused on, me personally, I focused on how do we get Bitcoins in the hands of as many people as possible? How do we grow the price? How do we create demand for it? And how do we get people buying and selling this to grow the pie, to get people using it? And the past 6-7 years, we've done a really good job at that. And the price has really grown and the technology has grown. And we're at a point now where we have some fantastic infrastructure built. We have some fantastic technologies built. And I think it's time that we start using the technology that we have and create some applications for it that we can go present to the world and say, here, this is what you can do with blockchain technology. I used to be, I don't like to use labels or terms, but like kind of the Bitcoin maximalist. I was very against altcoins, but I had a lot of time to think about the future and my life and how it relates to the cryptocurrency space. And I realized that there can't just be, we can't just put down and censor and throw down what we don't like just because we like one thing. We need to try to work together and figure out a way for everyone to build all this new technology together. And when I got out, I started looking at new projects that have started over the past year. And there are a few good ones, and I decided to invest in them and to look into them and to see what was being built. What kind of got me a little, I'm not going to say angry, but what got me a little turned off was people were still raising crazy amounts of money on the promise to build more technology and to build more. And that kind of came back to, well, we have technology now. Like, let's use what we have and try to create some applications for it. When Jason contacted me, he said, hey, Charlie, I've been developing this pipeline of companies to start my own private equity fund over the past year or two. And what do you think if we do this on the blockchain? And I said, wow, like, we can do this. We can actually put a security, a token that's backed by real assets on the blockchain. That would be a real amazing utility and use case for blockchain technology. So let's do that. And we created this hybrid model that takes private equity and then takes blockchain. So you asked in your previous question, like, why do this? What are we doing here? And so, of course, creating a token that's extremely liquid, that can be traded between two people on a peer-to-peer basis. Having that, it was really exciting for me. And then to be able to do distributions on the blockchain, on Ethereum, and show the world that this technology can do some really cool things. And after speaking to a lot of people in China, we learned that there aren't a lot of options for Chinese and Asian citizens to invest in the United States economy in middle market companies, profitable companies that are sub $10 million, mom and pop companies with hard assets. There wasn't like a good vehicle for them to do that was liquid. And so we decided to create a product that caters to that market.
Cool, thank you. So what I'd like to do is just kind of dive a little bit into the process of what you guys are going to be doing as an investment firm, and then I'll kind of open it up to, I know Alex has done a lot of work into the nitty gritty of it, and I think he has a couple of comments and questions, and then we'll open it up to everybody else on the call as well. So could you guys like take us through the investment process here, like from your fundraise, how much you're looking to raise, what that money is going to go toward, and kind of the process of finding companies, investing in them, and eventually sharing the revenue with your token holder constituents?
Sure. Well, the last 9 or 10 months, I'll give you a little bit about my background. I came from a family office where we managed a number of different funds, had a number of different joint ventures that we were a part of. I really wanted to get more into kind of Main Street America, hence the name for the fund. A lot of the work that I did was in the senior living business. We had a healthcare, a number of different healthcare startups and operations that we managed and ran. One of the trends that's really interesting is that baby boomers are going to need care, healthcare, a significant amount of healthcare, and that was a lot of the research that I did. But when I really started looking at the types of middle market companies that were available, primarily in the Midwest to begin with, there seems to be a continuing trend. Those baby boomers that are going to need healthcare down the road are in their mid-60s today. And they're going through, there's a lot of these neat companies that are growing, that have had steady cash flows, they've been around for decades. And they're now at a point in their life where they're saying, okay, how do I transition out? I don't have anyone to transition the company to. I've got a lot of value in the company. I don't know how to get out. So one of the things that I did earlier this year was really start to work with a lot of financial advisors, a lot of financial planners and estate planners, and of course attorneys who are working with these clients to try to figure out what to do with their business. And the first question is, okay, what's it worth? Second is, how do I sell it? How do I market it? The third is, well, who's going to buy it? Because they created a legacy of working, building their dream for 20 plus years, and they don't want to see it gobbled up by the typical private equity firms. So they come in, it's an aggressive business. There's a bidding process, and they want to make sure that their legacy continues. There's a lot of those companies out there. But then there's the select few that we've focused on in this first round that have some uniqueness around. Some are in markets that are highly fragmented. They really haven't been touched by larger private equity groups. The sanitary waste business is an example. Then there's another company that is in the manufacturing development, a very niche market. They've got some new patents they've created for processes in the engineering space, design and engineering space. So we look for uniquenesses of unique companies, and this kind of gets into some of the details of the questions you asked, Alex. Okay, well, what is middle market? Well, true middle market's anywhere from $10 to $500 million. Sometimes you call lower middle market, mid middle market, and upper middle market. We're looking for companies that we can take and get them into those spaces. And there's staples, there's steady growth, there's significant margin opportunity. And we go in with a leveraged buyout option where we make a purchase. Most of the time it's going to be a purchase of 100% of the company. Sometimes it'll be a controlling interest, but we really try to focus on the one where we can have 100% buyout. And then go out and leverage most of the purchase price. So our typical example, we'll start out with, maybe it's easy, but I wonder if I can put my Bluetooth on. It's easier to go on the board for me sometimes to be able to go. So I'm going to undo this. Okay. I think that'll work. Does yours jump to my screen? So what we've developed is a pipeline of companies, and I'll just kind of go through a list of them. We've got a sanitary waste business. I hope you can see the whiteboard.
We see it. It's great.
Can you see what I'm writing?
Sanitary waste.
I think it's almost better if we leave it on Jake's.
Is Jake's better? I'll write in blue so you can actually see it better.
And
Yeah.
maybe black if you write it bigger.
So I'll write it bigger.
You have magenta?
Magenta. And I'm going to talk through a little bit of the structure that we've done. So you guys can understand. And I'm going to have to somewhat speak vaguely because some of these are under NDA. Actually, all of these are under NDA.
I'll just call this real estate for now. So we get into the structure. First of all, as you guys in the offering memorandum. This is always helps to draw this up. So first of all, why is that the third split? Probably the question. The 70-30 split is equity. 70-30 is in the ownership of Main Street. And Main Street is going to have all the entities underneath it. Okay. When we go and look at the company, we have this one. This one's the easiest to use because it's under the purchase agreement. Okay. We just got a financing commitment. And the structure of that deal, that is $5 million of a purchase price.
Hey, can you mute your computer?
We have $1 million. This $5 million comes into the form of $1 million that we use mint funds for. Then I went out and I got $4 million of bank debt to finance the remaining portion of the transaction. Sanitary waste is a cash flow business.
Right.
Not a major amount of real estate, not a major amount of plant and equipment, just trucks transporting waste, picking
So
up
maybe,
up.
before we get too far down the path here, I think one of the things we were discussing is that private equity is an extremely competitive business, right? And there are guys that are out there brokering business sales to, a lot of people with checkbooks and very good operating experience. So, I think you guys are trying to position yourselves at, what we might call the, lower end of the middle market, but you also sort of discuss the investment strategy being stable and growing companies. And I think that that's a little bit the best of both worlds. So, maybe this sanitary waste business, now that you're you've laid out a couple companies here that we can discuss, is an example of a cash flow business, but it maybe isn't going to be that 20% EBITDA grower where you're expanding it really quickly and turning it into a $50 million business, for example.
That's a great example. That's a perfect example. Did everyone get that? Can everyone hear what Alex just asked?
Yep.
Okay, good. Just want to make sure it was heard. So let's use that sanitary waste example. Revenues are at 2.5 million. That was actually 2015. I'm just using the numbers that I know that stick in my head. Those revenues are actually closer to 3 million today by the end of the year in 16. This is 15. Cash flow, net distributable cash flow that was available was 800K. Those are good margins.
Yeah.
He is closer to $1 million now, $1.1 million. What we've done is we've taken his business, we've financed the first portion, and what we've done is we have a pipeline now of 20 plus companies with not the same level of cash flows that he is, but that are probably closer to $500,000 in cash flow. These are mom and pop organizations, husband and wife teams that have 2 or 3 trucks, and their margins are closer to 50% because they have no overhead. They just pay themselves. They're around 250 grand, 500 grand in revenue, net to them. Those purchases happen, as you obviously can see, this purchase we made on, roughly it's going to be, by the time you add real estate, it's about a 5.6 multiple. Pretty reasonable. These are on a 1 to 2 times multiple. You're basically getting people, a couple, husband and wife team, that are in their mid-60s that no longer want to run a sanitary waste business. They're all in this. When you look at the demographics, and the owner of this business that we've been working with, the seller, is very well connected into the industry within the Midwest. And so he's kind of got an inside scoop of all the other people that have been coming to talk to him, because he's got one of the larger businesses that are in the industry, saying, hey, would you like to buy my business? So, and they're all at that age. So we can go out and buy that cash flow for much cheaper, roll that all into the one business. And our goal is that this $5 million business eventually turns into a $10 million business by the time we're done. And eventually over the next 2, 3, 4 years, we eventually hit that $50 million mark. Our goal for this one business is to take it national in 10 years.
So you're going to execute upon a roll-up strategy, with smaller mom and pop businesses into what we'll call this one a platform. And very good strategy, definitely makes sense, well liked in the private equity community. I guess maybe you could sort of just walk us through the structure, because a $4 million loan on a cash flow business with the $5 million purchase price is rare, or I haven't heard of it much. So is this a mix of a real estate loan, or is it a cash flow loan that you discussed? Because you really need cash flow loans to be able to create one entity and scale it really quickly, with your lender, and not having to involve all the property.
The lender we're working with in Michigan we've talked to them about the fund that we're creating and the overall debt need that we're going to have over the course of the next 12 to 18 months. So let's take the larger chunk. You got $25 million that comes in from the mid, and the goal, we're probably going to leverage that up with about 50 to 60 million of debt. Not all of it is going to be full recourse debt. So that's going to get you to a total company value of anywhere from 75 to $85 million of total value once the 25 million is placed.
The 25 million is the equity capital?
That's the equity capital, and they bring in 50 to 60 million dollars of debt.
Okay, but how are you bringing in that debt?
2 ways. For this business, what we've done is we've structured the $4 million into $3 million of bank debt and $1 million of seller debt. Seller debt's over 5 years, bank debt's over 10 years.
Yep.
That's all personally guaranteed by me personally. So when you look at the model of 70-30, I basically mean, if let's say we screw up and we screw the business up and it goes to 0, my risk is at 4 million. The investor risk is at 1 million.
Okay.
Go ahead.
It's a little bit of a different structure than I initially saw in the OM, because the OM was talking about more of a, that was the carry level. I didn't realize that was the ownership level split for the 70-30. And
I think it's also 70% carry. It was over like 10% hurdle rate.
Right, I think that's where it flips to the ownership carry. But I guess the biggest issue I have with personal debt is that it creates a massive conflict of interest between the equity and the debt. And you are representing investors who are into equity dollars, yet you have a personal guarantee on the line for the debt on the business. And I think that it's certainly a good way of getting leverage, and I know you're putting everything on the line in order to make this happen. And on one level, it should be totally appreciated, and that you're leveraging the businesses, and that the equity is getting a nice return on that. But if, for instance, there's two levels of business. There's the debt and equity then, and you're sort of in control of both. And if the business suffers a bit, and for a personal reason or other, totally unbeknownst to the investors, the bank calls up and says, hey, we got an issue with your personal guarantee, we need to foreclose on the debt. There's a very strong interest for any manager in that position to then take more equity capital and pay down the debt when the business could be broken or have another issue.
Oh,
that
you're talking
different.
more equity capital out of the pool?
Yeah, I'm saying like if in this example, okay, we're at 3 million and a million, all of a sudden, let's say you have a bad year and this goes to 500,000, all of a sudden the bank is levered, the bank's levered 10 to 1 instead of 5 to 1, and then they want to, so you break some covenants in your personal loan agreement. Then the only way to fix that is to put more equity into the business, and then so it's the shareholders here that could wind up bailing out a personal loan. Or is the personal loan on?
Well, it's not a personal, it's still gonna be a business loan with a personal guarantee. So they're gonna have access to all the assets of the waste business.
Right.
The waste business will be the borrower.
Yep.
They're looking for me to back all that up. Because there's nothing other than the cash flow.
Well, one of the value propositions that we bring here, Alex.
Once you get to a certain point,
Charlie's got a
I was saying one of the value propositions, Alex.
Hold on, let's get the.
Can you hear me?
Go
ahead, Charlie. I was saying one of the value propositions here that we can't discount is. Can you guys hear me?
Yep.
It is. Oh my God. All right. Two of the value propositions actually that we shouldn't discount is that fact that again we're not building a platform of saying, hey, give us your money and we're going to build a private equity, and do all this. We've already put together the pipeline of companies. So the $25 million that we're raising is actually spoken for. We have, I know private equity is extremely competitive, and that is a true fact. If we were to go out and say, all right, now that we have $25 million, we're going to go out and look for these companies. That's not the case here. The second point is Jason has a relationship with this bank for, Jason, how many years? And the president of the bank directly. So when it comes to these loans, I mean, that's one of the things that our value proposition is, one of the things that makes us competitive in the space.
Jason is still in.
But I want to get into, how this transfers into a token in terms of dividends.
Sure. What else do you want to do before we erase this?
No, I think you're fine to erase that. Okay. We'll get to some of the other economic stuff later. I mean, I think it all makes sense. The personal guarantee to me just creates a little bit of conflict of interest when you should just put a little bit of money side by side with the investors, or work on a cash flow basis with the lenders. Because I'm sure they'd be willing to lend against a nice business like that and grow their support for the business, but maybe just not have 5-to-1 ratio, 4-to-1 ratio.
Oh, from a leverage standpoint.
Yeah, from the leverage standpoint.
Well, the leverage standpoint, though, creates a lot more value for the investors to be able to provide those returns.
Absolutely, but it also creates more risk, right? So it's part and parcel with risk and leverage, because they have a lower slice of the capital structure. Should the business become worthless or be forced to sell, it's like selling your house when you put 10% of that, right? Yeah, the price goes down a little bit, then you're the first lost piece. And we could sort of, I know the discussion will evolve, and I think the actual economics back to the token, are one of the key value propositions here. So, we can move on to that.
Sure. Well, and one last point, when it comes down to the first company, it is a higher leverage, but then as you start adding on the high levels of cash flow, that changes your whole structure of your debt to cash flow ratios.
I know it does, but I mean, I have a list of 300 lenders that I look at when I'm looking at an acquisition, and there are specific guys for specific purposes that I think is relying on one bank to always be there. After we've seen all this consolidation, we've seen a lot of volatility. I see guys in this space that are either absorbed by someone else and totally have to change their business model, or people that are get the hammer put
put down on them because they've had some bad loans and they have to, sort of lower their risk profile. So it's a space that really demands, lender capacity in a variety of ways. And competition. And competition. There's guys that understand certain businesses better. So I think there's just a way to really simplify the strategy, still raise the same amount of money, potentially still buy the same amount of companies, and in fact, maybe raise your second fund after this one is successful earlier, that we can also discuss. But I think that when we talk about going out there and providing stable returns on middle market businesses, but then you go out and throw a whole ton of leverage on, and you create potential conflicts between the debt and the equity. To me, it's just not as in the spirit of openness and transparency that sort of demanded by the blockchain community. But I know that that's why we're building systems and good ways of reporting back to the community so that they can follow through on all these events, they can follow along on all these investments and learn more about them as you sort of go through your diligence process, but also once you own them, and how they might be able to help you, and all sorts of things that come along with having a big network of investors. So I think that that's a lot of your value proposition to distributed token interest. But it's a long investment cycle, right? So a lot of people in the blockchain community think they're going to buy into a token and it's going to pop the next day. What you're going to see here is you're going to buy a business and it's going to take a while for those changes to be implemented, and the value to be created. And that's why private equity historically has been people with a lot of money who incredibly invest their test and are happy to let it sit there for 5 to 6 years and know that they won't have to kind of go out and pull the trigger and sell it at a discount or a loss, which could be meaningful because it is truly a liquid asset class. But bringing the level of transparency that you guys want to bring to the space, really could make that a viable liquid asset class, which I think is what's so interesting about what you're proposing. I just hate to see potentially the structure get too complicated and you guys get bogged down and things like that while you try to kind of bring it to market. So,
well, I want to use this example because this is helpful because it helps to explain the carried interest structure. Let's use imaginary number. We're going to finish up with this because I want to answer Chris's question. So Chris, you asked about distributions. And that leads into, Alex, what you were talking about as it relates to transparency. So we'll stick with one, sanitary waste business. Let's use this one company for $1 million investment. Based according to our projections with the accountants, our first year of distributable cash flow after debt service is about $500,000. What we intend to do, and let's just say that runs on a quarterly basis, straight line. What we're going to do is, at the end of each quarter, we're going to go through a reporting cycle. We just got preliminary approval by a top 4 international public accounting firm who's going to do all of the auditing for the fund. And so every quarter, we're going to do an annual audit, but every quarter we're going to do a quarterly report, financial report on every asset in the portfolio and how that rolls up at the holding company. We'll do a snapshot of all tokens that are outstanding at the end of each quarter. And then what we're talking about with, it looks like we're going to move forward with one exchange. I think that'll be announced after the first of the year, who's going to list the token after the sale. They're going to have a mechanism whereby, so when you do the token sale, let's say we have 100 token holders. Those token holders, that's 100 addresses. Well, those token holders then go create with their 100 addresses, they send that all to another 100 addresses that are offline. They're on chain, but they're not public through the index, because all of this has to go through KYC, AML, from a regulatory standpoint, right? Then they go off and send it all to cold storage. So now you have 200 addresses that are out there on the chain. What we're going to do is we're going to have a mechanism where instead of, because one of the things we're prevented to is pay out distributions to anyone in the EU or the US. It's one of those regulatory things. It's a security. We can't. This is the way it is. Yep. We're gonna have a registration process through the exchange where people can say, "Hey, here's my public address. I want to go send it to you. You have all my information. I've already gone through the KYC, AML. I've already registered my account. I'm gonna give you my address, and that's where I want you to send my distributions to." So when we take the snapshot, we're gonna have a snapshot where people have to go in, show all the tokens that they have, and then they'll get the pro rata share of distributions on a quarterly basis. So let's use, for example, this 500K. When you go to, in this one instance, it's a 70-30 split. We've already hit the 10% pref.
On both sides, right?
On both sides.
10% for you guys, or 10% for the token holders,
Yep.
10% for you guys, then 70-30 split thereafter in the company's favor. But that's on an individual asset basis.
Yeah.
Correct? Or individual investment slice of an asset.
Right. So when you take, here's investment A, or here's about 1, 2, we've siloed that only for this, not for our benefit, but I want to get into some other examples where maybe it's not a cash flow purchase. Maybe it's 3rd round, 4th round, final round seed money to acquire the way to market share. I'll use an example. Let's go on with it. You guys understand the functionality of this one asset and how the cash gets paid out? Okay. We've got a unique company. I call it in the digital media space. If I said too much more than that, it'd be pretty easy to figure out what it is. They've gone through one round, they've gone through seed round, and they've gone through 2 series of funding. And have received $9 million of venture capital funding. They're cash flowing. But what they're doing is they're taking the cash flow and throwing that towards future business development to increase sales. Very unique opportunity in a very kind of a specialized space. But in a space that's very similar to some other people that have consolidated in other areas of that industry. That would be an opportunity for as much as a $10 million investment to acquire $20 million of the competitors. There's 2 different companies that equal $20 million value approximately. We may go as much as $10 million. And that's not a cash flow business. So that would be the example where we keep that in its own silo. That's a 4 to 5 year exit strategy. Mm-hmm. They got a grow plan and then flip it. That's the timeline of the existing venture capitalists, the existing venture capital investors. That exit would measure the returns upon the exit. But if we start to say, okay, these businesses are kicking out cash flow, this one's kicking out 0, this one's kicking out 0, and they all have different investment strategies, we thought it'd be best to keep everything in its own gates.
Yeah, but I think it promotes, what I'm confused about, I guess, is like the buying power you will have from the 25 million is not a lot to go out and have 3 different distinct strategies. So if you are, working with sort of a blockchain investment that could add some type of synergy to better reporting within the sanitary waste business to tracking cash, I think that's kind of the synergy I thought of when I was read through the OM. But to actually take 25 million and sort of have some VC bets, some blockchain bets, and have a private equity strategy.
That's not true. We don't need to actually acquire the blockchain company that we're going to be doing the synergy with, I've already looked into specific companies that can provide logistical or accounting efficiencies for the sanitary waste business companies. And in the beginning, a joint venture would do just fine with that, because these companies are looking to take their technology that they've built and provide a utility for it, provide a use case for it. Down the road, if an acquisition is something that we want to do, I mean, these blockchain companies don't have crazy valuations to purchase a majority. They're not $20-30 million companies. So giving that ability for them to do that, I think is a fantastic strategy, because that's what my team will focus on within the company, while Jason focuses on the private equity side of things.
And I have no doubt, like I think there's tremendous merit to that strategy, but the white paper laid out more of like a, let's call it 30-30 split between the types of assets you'd be buying, so the 30-30, third. So I think what I'm hearing you say is that you may not need $10 million or $5 million to pursue that strategy, but in the paper it sort of had said 35% for blockchain investments, right? But I think what's difficult here is that when you have those different strategies, the deal by deal carry and the investment by investment carry just doesn't, may not get all investors comfortable that the economics work in their favor, especially with the 70% back end carry. If you have a couple investments that really knock it out of the park, blockchain company or the sanitary waste business roll up, could go from $5 to $50 million. I think that investors would want to know that they're going to get their original basis back before the company starts earning significant, the 70-30 split, for instance. So maybe we just discuss how you came to the 70-30 split, or why you think that's sort of the fair distribution of carry.
Well, the assumption was back to the original 25 million, to make it easy, to combined with $50 million of debt. I think it's actually more than that. That there would be a significant amount of risk that IntelliSys and I would have to take to be able to go leverage that. Now, let's go back to this example. I mean, I'm being provided, maybe we don't take the risk on $10 million. This comes to an example where if I'm not going to take personal risk and IntelliSys doesn't have to put itself as a guarantor, maybe the structure is different that those companies require. Maybe we give them shares in the new company. Well, and this doesn't talk about the white paper, which we're still trying to flush it out. We talked to the guys at Smith & Connell about this. That 70-30 split, we're not going any higher than that, but that allows us to risk adjust. Meaning that we're not taking the risk on that, it's not fair for us to get paid the 70%. Zero mandate.
It's a zero. It's the 10% operating costs built in, which is sort of like a over time, running the business and things like that, right?
Yep, that's basically startup costs that all get paid back to the fund. And that's still outstanding debt. Token holders.
Right, and that's part of the original basis. It's part of the original basis. Yes, 90% of that money will be invested. So I guess another thing about the token that I had a question on is.
Well, let's get back to this.
Okay, sorry.
So let's say we go out and make this acquisition. The model shifts. We don't have to put any personal guarantee. We would go back down to a 20-80 split of a carry.
I mean, that if you look at sort of some of the data in most private equity funds, that's what it is. I think what's being complicated is you guys are looking at the debt capital as equity capital to determine that 70-30 split, but it's not.
Well, we're not looking at it as capital, we're looking at it as risk.
Right, but exactly. So you're looking at it as risk,
Yes.
but it's being unfairly treated as side-by-side capital to create that 70-30. I mean, that capital is reason banks charge 5% because it's not as risky as the equity. The equity could go away and the bank can take over the asset. So it's not I wouldn't say that if you were bringing $50 million and I was giving you 25 in equity, that would be a risk. But at least that's my opinion.
So in terms of the token, is the token, is it supposed to increase in value, or is it just a dividend generating machine? Like if you raise 25 million and you've got 25 million worth of tokens, let's say, will those tokens appreciate in time, or are you just creating it as a way to create dividends or distribution?
It should be both, right? Is it only determined by the secondary market as well?
Yeah, and like how are you valuing, like let's say I buy in, right? And full disclosure, I got a late invite, so I don't need to read the paper. So I'm an idiot. But if you buy in, let's say I buy in the crowd sale, right? And then in 3 years I want to exit. How will my token be valued? And like how periodic is it valued? And I guess I'm just trying to figure out the difference between token price increase versus distribution.
Sure. Well, initially the token is going to be valued at roughly $1 coming out, okay, per token, US dollar. Eventually, that token should be valued based on the underlying value of the portfolio. So let's say we place all the money, all of these buckets are filled, we've got money coming in the door, there's a valuation for the asset, for the cost of the business, the value of those businesses. We're hoping the market prices that in, just like any other publicly traded stock. Where they're looking at the underlying value of all the assets in the portfolio. And then we have analysts that are following and saying, okay, well, here's what we see that token should be valued at. Here, what do you got? I had a piece of styrofoam in the holding. That's the goal. Plus the value of the distributions that are coming through the cash flow.
Got it. So then the market is actually the one valuing the token.
Should be. We would expect in 2 or 3 years that we're being followed by analysts who are always looking at our financial statements that we're providing. And each quarter, even, those tokens will be adjusted according to, obviously there's a buying and selling factor, the speculation, but then it should be based on financial projections of what we're doing. And not really.
So you'll do the initial raise, that the total AUM of that initial token is 25 million, and it'll fluctuate given the demand for that token market. But
Exactly.
should converge upon basically the equity valuation of the token.
Yeah.
Okay. And then it's creating distribution cash flow over time.
Correct.
To the token.
Yeah.
And it's all within one of these exchanges.
Yes.
And is it accredited investor token?
Well, it's non-US, non-EU investors.
Okay.
But there's other ways that US investors and EU investors could want to invest through offshore entities. It happens all the time. Right. We expect that there's going to be a fair amount of activity that goes on. But what we see is there's a lot of activity and a lot of interest from areas that are trying to get out of their country and into the US and invest in US companies. Right. So we see a lot of activity in China. We see a lot of activity in the Middle East. A fair amount in Russia. You've got a spattering throughout.
Cool. Jason, I just want to echo like a question that was posted in the channel there. Like, just fundamentally, like why go through regulatory hoops? Why alienate like the U.S. market, the European market, when potentially like a similar raise could be had in sort of more traditional terms in the U.S. from accredited investors or et cetera. Like, I guess I'm getting to the core of the question is like, why do investors want to have a token rather than invest in the traditional sense here?
When you invest in a traditional fund, your funds are locked in for a certain amount of time, whether that's venture capital, private equity. We sat with a big VC fund the other day that is going to be buying some tokens, and he was so interested in the ability to be able to invest and create tokens on the blockchain and issue securities. He emailed me a week later and he said, all right, if I want to issue shares in my VC fund on the blockchain, how do I do it? Because that ability to have a liquid asset is something that I see as a huge value proposition. It's a psychological thing too. People will be more willing to invest in something that they know they can get their money out. They'll be more likely to invest in that. It was one of the biggest things I saw in Bitcoin. People got angry at me when I wanted to add a Bitcoin debit card, and they said, "Why would you want to do that? Because now people are going to want to sell their Bitcoin." And I explained that you need to give people the ability to sell something, because then they're not going to want to hold it. It's the same thing like a bank run. If you try to tell people what they can and cannot do with their money, then markets will fail. If the banks close up and say you can't pull your money out anymore, it's locked in now for a certain amount of time, everyone's going to want to get their money out. So that's one of the reasons that I saw this be an amazing idea to be able to put private equity on the blockchain, was that it's a liquid token asset.
Okay, so once you sell this token to a secondary market to somebody else, that new holder, that person will also have the rights and the responsibility of the original one. Like for example, he has the ownership of the mainstream, and also has some voting privileges and so forth.
Yep.
So it's kind of like
that token represents ownership in the shares of the fund.
Do you have to? Does it have to stay within the one exchange?
Absolutely not. No. You could use any Ethereum wallet. You can transfer it. You can print the private key on a piece of paper and give it to someone. It's completely. It has all of the abilities that any token does have. The only thing is, when it comes to distributions, because we can't allow distributions to US and EU investors, when it does come time to distributions, it's going to have to be done. We're looking to have it done by the exchange, where they can verify that you're not a US or EU resident. That's the only difference. So what we'll probably see happen is, if there are American holders of the token that somehow got it, they'll probably sell it before distribution time and people will be buying it at a premium, since the community will be constantly updated about happenings within the fund through that investor portal that we're going to be launching, and the quarterly reports and the constant community updates. People will have a good idea of how the fund is looking that quarter, and I think we'll see a lot of volatility every 3 months, or a lot of if there's going to be a distribution, you'll see the price go up and the pumps, and then if the fund didn't do all that quarter, the price will dump, and you'll see a lot of volatility in that space, and it'll be really interesting to see how that kind of plays out with distributions.
Charlie, can you talk a little bit about how distributions work? How often they are, and how does the money flow?
Okay, so there are two ways to do it. It's a quarterly distribution. Now, we're obviously not guaranteeing. You can't guarantee anything, but looking at just the way the companies are operating now, and looking at their financials and seeing what their margins are, assuming that we do a distribution, right? How would it work? There are kind of two ways to do it. There's doing it on chain, which where what you would do is you'd announce a snapshot, and because we have every address that is created on the Main Street token, we have every address. We can essentially do a kind of like a snapshot of the whole blockchain, and essentially distribute Ether to all of those addresses at that specific time. That's one way to do it. The second way to do it is to have if you have an account at the exchange, you'd register your address there, and then the exchange would issue your distribution in whatever currency you'd want.
And is it distribution kind of on a regular basis, or is it discretionary? Do you have a minimum? It's quarterly.
Quarterly, yeah. Sorry, I thought I said that. Yeah.
I'm sorry, it might have been my fault.
You know what's interesting about this, because given the illiquidity of typical VC and private equity funds, they price at a slight discount. You guys could be priced at that.
That's what we're hoping. And frankly, take back to your original question. Why take out a lot of the marketplace? I mean, the US and the EU represents a significant market of all blockchain investment. in cryptocurrency investment. One of the things that we're trying to do is we're really the guinea pig in this space. The regulations aren't there yet. There's this big gray area on how that's going to be handled by the SEC and all the other agencies. But change is coming. Change is coming, I think, probably in 2017, we're going to see a lot of clarification to the Delaware Blockchain Initiative and some other areas that are really pushing regulatory reforms related to blockchain and cryptocurrency. Our goal is that if we can set this up and do the raise and start to show that we're, start to prove that we're doing exactly what we said we would do and set out for, and that it is becoming successful. And we're following all the same rules and requirements that we typically have to follow here in the US. Our goal is that we can be first to be accepted as something that's already a going concern and be the first private equity fund on the blockchain based here in the US.
Kind of pioneering.
Yes.
So recently
our goal is we want to be a US based fund.
Gotcha. Recently there was I think it was an Ethereum meetup. It was held at Cardozo Law School. I believe Marco Santori was there on the panel. And like I wasn't there, but I heard it secondhand, like kind of the opinion that Kevin was there, that what is actually very, very not unlikely now to happen in the next like 5, 6, 7 years is a change to the definition of accreditation in the United States. So sophistication could be measured by a test rather than by kind of income, right? Is that the kind of regulatory changes that you would be looking for?
1 second, we don't want to get covered.
Yeah. Okay, Dan is correcting me that it wasn't Marco, it was Human Shadab. That's correct. That was my mistake. But so, what kind of regulatory changes would you be looking for in the U.S. to enable this model that you're trying to build?
Blockchain-based securities is the #1 change that we're looking for, and I think we've already seen big movements towards that, right? We saw the SEC come out with regulatory changes for crowd funds, you know, with certain limitations on it, up to $1 million, and you can't invest in so much of your worth. That opened the door to the overall bigger picture of crowd sales, and I think it's going to create a decentralized investment community where everyday investors can have an opportunity to get in. Now, if everyday investors get in, the burden of risk disclaimers is going to be significant for the company. But for startups, it would allow them a much easier way to get accredited investors in. And if there was an actual tradable report, if there was obviously we've got exchanges, if it was readily available to be able to go to an exchange where that investor, you know what, I want to sell it to someone else, I want to get it out. Those are the types of burdens that we want to see come off, is the transferability. And today in private equity in the US, transferability is the #1 restriction.
Cool. Yeah, I think, you know, blockchain on digital assets coming onto the blockchain, real assets, private equity interests is sort of the next frontier of what is going to unlock so much value for us. So, you know, I think it's extremely exciting. You know, I think we discussed how, you know, both the NAV could grow and the dividends will grow, and you know, people will be able to have visibility into that. I just think, you know, definitely recognize that because it's under that model, you know, I think everyone's interest in the fund and the money they put in the fund should be, you know, treated as, you know, this is a $1 investment or $1 Ether investment in the fund, so that all the economics that you guys you know, discussed and laid out sort of don't change based on the kind of theory structure. But I think that, you know, it's a very exciting space, and you guys want to sort of the pioneers in whatever wants to
Yeah.
say they can do that.
Well, it is exciting.
Thank you.
There's a huge amount of risk that we've had to really analyze, both financial risk and legal risk. It's kind of uncharted territory, so we're trying to do it the right way and get the right feedback from the whole community.
Awesome. Cool, guys. Thank you very much. I think we have to wrap up because we're running out of time. I want to thank everyone who came to join us live here in Union Square, including Alex and Kevin, and an unnamed guest, and and everyone who's joined us here online. I'm sorry we didn't have as much time as we thought we would to take more questions from the audience, but please come to the IntelliSys research channel on the CoinFund Slack. And Jason and Charlie are quite often there to answer your questions.
CoinFund's
Well,
live.
we're do another meetup or another AMA, aren't we?
That's right. And catch other AMAs with these guys before their sale. Thank you.
Thanks, Jason. Thanks, Jason.
Thank you, Alex. Thank you, everyone. Thank you, Jake.
Thank you, Charlie.
Thank you.
Bye, everybody.
See you later.
Thanks.